And then there's capital stack, managing the capital stack. You're going to see that leverage really can enhance return, but there's a difference in value, leverage that enhances value and that which destroys value. The different parts in the capital stack include senior debt, subordinated debt, and equity. And when these all go together, the total value of that should be the value of the property. Now, what's interesting about equity is that equity is like a call option. And a call option has a strike price. And the strike price of the equity is paying off the underlying debt. And what happens in some cases is that the value of a property or even a company can go down so far that there's very, very little equity left. And the management starts to manage the company like in fact the equity is a call option. But there are all these different pieces, and so people who invest, who are successful investors, know how to structure and how to manage that, and they create value by how they manage. Next. Now I want to talk to you about how to measure risk. Now, risk, as I said earlier, is something that's treated anecdotally. But in fixed income and other areas of the capital markets, we think about it slightly differently. This is a probability distribution or a histogram of the NCREIF Property Index. And the NCREIF Property Index is an index representing the returns of institutionally owned real estate in the United States. And what we did is we created this index. The average return is 9.4% over time. And there are some outliers. Some instances where the performance was low and some where it was very, very high. So when we think about risk, we think about risk not only in terms of the average, but we think about it in terms of the spread. All right, and that's a key thing. And unless you think about it that way, you can get into a lot of trouble. So when we look at deals, sometimes we actually model the deal using Monte Carlo analysis in some cases, and that allows us to understand the spread of the possible outcomes, and it helps us to get a better idea of how to price and manage risk. So the notion here is the return and the risk is measured by the spread. I'm going to come back to that in a second. Okay, now let's take a look at one way to look at capital market instruments, and this is very important. This is something called the security market line. And the slope of this line is determined by a lot of factors in the capital markets. And if you think about it for a second, if this is risk and that's return, and this is zero risk, this would be the risk-free rate on short-term treasuries. And then you could populate this with a lot of other kinds of capital market instruments like treasury bonds, US AAA corporate, all the way up to small cap stocks. Small cap stocks have a lot of volatility, so they're up there, but they also have a lot higher return. So if the market's in equilibrium, all these points should be along this line, right? And it has a slope. And the slope is, the return minus the risk-free rate divided by this little thing called sigma, which is the measure of risk. Next. Now, I want to make a point here, and this is a very important point. We can do anything with real estate, just about anything with real estate, if you think of those quadrants, almost anything with real estate that we can do with corporate bonds and corporate stock. It's just simply another financial asset. And if you look at it, it's the same kind of line here. We have AAA senior debt, real estate debt, commercial leases, which are bond-like, core real estate equity, mezzanine debt, value added, this is where we work, opportunistic and development. Next. Now here's the issue I want you to think about. If this is the equilibrium in the market, we know that the market is constantly getting shocked, right? And so nothing's in equilibrium. Everything's kind of approaching equilibrium. Now there are going to be times when, given the risk, for a value-added strategy, the expected return is much higher than you would expect in the market, if the market were in equilibrium. So that looks like a good strategy, and so is opportunistic. But in this particular case, and it may be for a certain asset class, a certain property type or a certain city, the development is out of favor. Because what I could basically do is, instead of doing this, I could do triple B commercial leases and leverage it up and I'd get a higher return than doing the development. And this is like a critical point. And the point I want to make to you, and this is one of the reasons I came here, is that I've seen very few firms that can make the distinction. And that's really critical. Next. And so the converse is there are some markets where value added and opportunistic doesn't make sense. And that's, Brad's area. Brad is building multifamily apartments, right? So development for him makes a lot of sense. But maybe doing high-rise multifamily in a lot of other cities doesn't make sense, okay? And he's very discriminating about that. So that's one way in which we can look at the trade-off of risk in a disequilibrium market. Next. Okay, now at the portfolio level, the question is how can we manage and mitigate risk? Okay, now at the portfolio level, you can diversify. And I want to make a point to you. There are a lot, and you're going to see a slide later. It's kind of I hope it's a funny slide, but it's a slide that deals with novel strategies and why they may not work. But the one free lunch in finance that I know, the one free lunch is diversification, because it allows you to shed risks to the capital markets that you may not want to bear. And the key thing here is that the market only rewards you for assuming risks that you can't shed. Think about that. If you can't shed the interest rate risk or you can't shed other kinds of risk and you must bear it, the capital markets presumably will compensate you for that. But it's not going to compensate you for bearing risk that you can shed. So there's this trade-off that people make between risk and return. And in building a portfolio, and we're going to see this in a second, you look for assets. You typically look for assets with a low correlation. Now this makes a lot of sense to you because you're managing portfolios, your own portfolios or somebody else's. From our standpoint, we're in the business of manufacturing investment opportunities. We don't manage your portfolios. So the other point I want to make is that while diversification can provide a free lunch in the sense that you can shed risk through diversification, diversification is not free. And when I used to advise CalPERS, I used to tell them the one thing you can do is write a big check. And instead what they did is they had many different property classifications, and they had hundreds of properties within each of these. And then they sliced and diced. And it was expensive doing that. So my point to you is that one, diversification is not free, and the other thing is that there's true diversification, and then there's a naive diversification, and you want to use true diversification. The portfolio asset allocation can change depending on what the liabilities are. A safe asset like maybe treasury bills becomes a very high-risk asset in the context of liabilities that are long-term liabilities, or they're synced in some way to commodities. So you have to also think, and we're not going to talk much about this at all, but you have to think about your portfolio in the context of the liabilities. And then there are ways of structuring portfolios to provide downside protection. There are hedging tools, et cetera, but there's all kinds of technology to help you build, manage, and shape the risk of these portfolios. Next. Now, when we go to the deal level, there are lots of risk elements. Entitlements. When does the property get entitled? The issue of co-investment. Acquisition lines. If you have enough capital, you can go out and provide capital market immediacy to sellers. And if you can close on a deal quickly, that means that the seller is probably going to accept your offer even if it's not the high bid offer. Good credit tenants, managing credit. How do you manage credit for non-public tenants? There's ways of approaching that. Working capital management and a whole set of other points. So these are all risk elements at the deal level. Next. So what does this mean? Let's now focus on two aspects of real estate investment. One is strategic management and the other is tactical. And this is where we're going to make some important distinctions. Strategic asset allocation is figuring out a target, kind of a long-term target that is subject to variation depending on your view of the long term. That's strategic asset allocation. And it's sometimes called the policy mix. And what you do with this is you adjust it over time. Next. And again, back to our security market line, you look for assets that have low correlations, and you try to find ways of combining these. Next. And if you combine them if you combine these in different ways, just with 3 or 4 assets, you can get a frontier called the efficient frontier. And what this is the locus of points such that at any level of risk you have the highest return. The magic of diversification is if you have a couple of assets below the efficient frontier and they have a low correlation, you can design portfolios by adjusting these combinations so that you can be on just about any point of the efficient frontier. But here's the point. If you're here, the beauty of the diversification is that I can increase my return. If I'm below the line, I can increase my return without assuming additional risk, or I can drop risk without giving up return. Once I'm at the efficient frontier, there's no more free lunch. Okay? That's the way to look at that. Now, I'm going to use this. And keep this in mind. This is going to be very important. Next one. Now, as an investor, you have preferences for return and risk. This is the same way you do for kumquats versus apples. There's a trade-off. And you derive utility by that combination. This is called the utility curve, and it shows the trade-off that an investor might have between risk and return. And as he takes on more risk, he or she takes on more risk, they need significantly more return. Next. Now, when you put this all together, this is the efficient frontier, right? And let's say we're in a world where we can borrow and lend. This would be the most efficient point. This is the point where the tangency of the efficient frontier and the utility curve here. But with leverage and with capital markets, what we can do is we can leverage up the portfolio. This is the efficient point on the efficient frontier based on the returns in the capital markets. We can leverage up the portfolio, and we can actually increase the satisfaction or the utility to the investor. So this is a good example of how you can use leverage to make investors happier.
So
Matt.
Randy, I have a question.
Yes.
Can you go back?
Yes.
Where the point where the efficient frontier, the optimal portfolio
Yes.
point, does it represent low risk and low return, or does it represent an optimal mix?
This is an optimal portfolio. If this line were, if we had, let's say, very high interest rates, the line might look like this, right? Depending on what the Fed's doing and a lot of other factors. And so the optimal portfolio would be up here. I thought you were going to ask another question, but I'll ask the question and I'll answer it because I think it's very, very important. What this says basically is that there's an optimal portfolio. Now, there's more than 3 assets out there. There's hundreds of different kinds of assets. But what this says is that everybody basically should buy this portfolio. And then depending on their taste for risk, they can either take on bonds, which is like lending, or they can take on liabilities, which is leveraging, right? But that's what this says. Now, people in their finance business are, financial planners, they're trying to sell different kinds of assets and different kinds of strategies. But in principle, what this says is that using borrowing or lending for an investor, and there's some investors up here and some investors that are going to be down here, maybe widows living off of fixed income, they'll be down here. But what this says is that you can use the capital markets at a portfolio level for an investor to achieve higher returns.